Hi everyone and welcome to Managerial Accounting. In this very first presentation, we're going to look at an overview of what managerial accounting is. Although you're not responsible for it on any of your testing or quizzing, I encourage you to read through the prologue so you get a really good feeling for what we're going to be looking at this semester and listen to this presentation. First of all, you are doing managerial accounting in this course. You've learned financial accounting already since it's a prerequisite for the course. But in financial accounting, the users of the information are external persons. So we're making reports for external people. The focus is on past historical perspective, last year's financial information, or last quarter's. The verifiability versus relevance. The emphasis on financial accounting is on objectivity and verifiability. Is it correct with regards to being unbiased? Precision versus timeliness. The emphasis is on precision, on correctness. We're not too worried about the timeliness of the information as much as we are about the precision. The subject, the primary focus is on company-wide reports. How did the company do overall? We follow GAAP or IFRS. And the requirements are mandatory for external reports. You have to follow rules set up by GAAP. Managerial accounting is different. Managerial accounting focuses on information for the managers. So the users of this information are managers who plan for and control an organization. There's still financial accounting happening in the organization, but there's also this other type of accounting, managerial accounting. The time focus is on the future. So we're going to be looking at budgeting. Verifiability versus relevance. We are more worried about relevance. Is it useful to me? Does this information help me make a decision? Precision versus timeliness. We want current information in managerial accounting so we make the best decisions. We're not focused on the whole company. We're focused on a part of the company as a manager. So it's segments, departments. There's no rules. We're not bound by GAAP or IFRS or any prescribed format. There's no managerial accounting rules out there. So these are tools that are used for managerial accounting, but not rules. And there are no mandatory reporting requirements in managerial accounting. Every company makes up their own using these tools we'll be looking at in this semester. So when it comes to managing, if you had a management course, managing is about planning and organizing and controlling and decision making. So we need that type of information from accounting to do this work. In planning, we want to establish goals, specify how our goals will be achieved, and develop budgets. So in a managerial accounting, that's what we're focused on. What's a budget? Well, that's details of what we want to do in the future, put in monetary terms. Controlling, the control function, we're gathering feedback. How well do we do? So here's where the company's at. Here's what we expected in the budget. Are we on track or aren't we? This is the information we're going to be looking at this semester. How do we do that? And then decision making. Managerial accounting will help us make the selection among competing alternatives. That's just economics. What should we be selling? Who should we be serving? How should we execute it? And I love this scale there because it's always a balancing act using our accounting from a managerial perspective to figure these things out because of cost benefit and also because of limited resources. So on the planning side, let's take a look. Marketing majors, managerial accounting activities for a marketing major. Planning. On the planning side for a marketing person, how much should we budget for TV, print, and internet advertising? How many salespeople should we plan to hire to serve a new territory? Managerial accounting will help us determine that. On the controlling side, is the budgeted price cut increasing unit sales as expected? So we said if we cut the price, that was our plan in our budget, the sales would increase. Well, is that occurring? In the controlling side, we're checking that. Are we accumulating too much inventory during the holiday season? The information produced in managerial accounting will help answer these questions. And decision making. Should we sell our services as one bundle or sell them separately? Should we sell directly to customers or use a distributor? Again, during this semester, we're going to use tools so that we could answer these types of questions, not only in marketing, but in any department. Here's supply chain management example. How many units should we plan to produce next period? How much should we budget for next period's utility expense? On the controlling side, did we spend more or less than expected for the units we actually produced? Are we achieving our goal of reducing the number of defective units produced? You can see here how managerial accounting will answer, or maybe not necessarily see it, but know that what you learned this semester will answer. Again, I know I said it a couple times, but it's the truth. We want to make sure you understand that. Should we transfer production of a component part to an overseas supplier? Should we redesign our manufacturing process to lower inventory levels? On a human resource side, how should we plan to spend for occupational safety? How much should we plan to spend for safety training? How much should we plan to spend on employee recruitment advertising? So on the planning side, managerial accounting will help us answer those. And then we'll see on the controlling side, is our employee retention rate exceeding our goals? Are we meeting our goal of completing timely performance appraisals? Finally, decision making. Should we hire an on-site medical staff to lower our healthcare costs? Should we hire temporary or full-time? So again, all of these examples are major departments within a company, and we're showing you that the tools we'll be picking up this semester will help each of these departments answer those types of questions. Accounting majors. So the IMA estimates, the Institute of Management Accountants, estimates that more than 80% of professional accountants in the U.S. work in non-public accounting environments. So what does that mean? We're not doing auditing and tax returns as maybe we once did. 20% of us are doing that, but 80% of CPAs basically are working in companies doing managerial functions, managerial accounting. Now, I could tell you from my own experience, I loved it. I did do, in my job as a controller, the financial accounting side. Yeah, we had to get financial statements together. But the majority of my day was spent on managerial accounting activities, where we were answering questions for departments, providing information, doing budgeting. So employers expect accounting majors to have strong financial accounting skills, but they also expect you to be able to plan, control, and make decision making, which are the foundations of managerial accounting. So you could become a certified management accountant, and I'm thinking about doing that credential myself this summer if I have time. I always say that, but and it's a process of learning these different tools and proving you know them on a test. And you have to have so much experience working as a managerial accountant, but a management accountant who has the necessary qualifications and passes a rigorous professional exam can earn the right to be known as a CMA. So there's people who leave accounting programs, never go into public accounting or have no interest in becoming a certified public accountant, want to go more on this managerial side and become certified management accountants as a credential. The CMA exam has a couple different parts. The first is part one is showing you understand financial planning, performance, and control. So you're going to be looking at planning, budgeting, and forecasting, which you'll learn in this semester, performance management, cost management, internal controls, and professional ethics. So these are all things inside of the company, as well as part two. You can maybe not prepare this financial statements, but you can analyze them. You understand what they mean. You understand corporate finance, decision analysis and risk management, investment decisions, and of course, professional ethics. And there's always that advertising. There's your information on learning more about becoming an CMA, and that's on the Institute of Management Accountants website, or you can call them. So the primary purpose, again, of this course is to teach measurement skills that managers use to support planning, controlling, and decision making. If you haven't figured that out already, they're tools, skills. So measurement skills help managers answer important questions. What net income should my company report to its stockholders? How will my company serve its customers? Will my company need to borrow money? There's 6 business management perspectives that are beyond the numbers to enable this intelligent planning, controlling, and decision making. An ethics perspective, a strategic management perspective, an enterprise risk management perspective, corporate social responsibility perspective, a process management prospective, and a leadership perspective. So the ethics perspective, the first of the 6. The IMA has a statement of ethical professional practice. So if you are a CMA, you have to follow these ethics, but they're also a guideline for anybody in managerial accounting. You have to have competence. You have to be able to recognize and communicate professional limitations that preclude responsible judgment. You need to follow laws. You need to provide accurate, clear, concise, and timely decision support and maintain your professional competence. Keep up on your education. Confidentiality. With anything, we are not required by law as accountants, either in public or private, to maintain confidentiality, but ethically we are. So do not use confidential information for unethical or legal advantage. In other words, if you know the company is doing really bad as a managerial accountant, or they're doing really good, or they look like they're doing really good, but you know something bad is going to come, an announcement's going to come, kind of like what happened with Apple and their iPhone sales. Then, and you go and you sell your stock. That's unethical and illegal. Okay, that's insider trading. Do not disclose confidential information unless legally obligated to do so. So in a court of law, you are subpoenaed. Okay, legally, you must disclose the information. So we aren't bound by confidentiality, even in a legal sense, but ethically we are. Ensure that subordinates do not disclose confidential information, and you deal with it, appropriately if it's proven they do. Integrity. That's a good word. Abstain from activities that might discredit the profession. So don't do anything that could be perceived as unethical. Mitigate conflicts of interest and advise others of potential conflicts. Refrain from conduct that would prejudice carrying out duties ethically. Okay, so you want to be careful with how you act and act in a professional manner with integrity. Credibility. You want to communicate information fairly and objectively, so you stay as unbiased as you can. Disclose delays or deficiencies in information timeliness, processing, or internal controls. And you disclose all relevant information that could influence a user's understanding of your reports and recommendations. You don't hold back. Don't sacrifice your credibility for anyone. How do you resolve an ethical conflict? Well, you should follow your employer's established policies. Most major employers have ethical standards, codes, especially after the crises in corporate America in the early 2000s with unethical behavior and fraud. But if there are none, or if it doesn't resolve your conflict, discuss your conflict with the immediate supervisor and next highest uninvolved in managerial level. If immediate supervisor is the CEO, though, you consider the board of directors or the audit committee. Contact with levels above the immediate supervisor should only be initiated with the supervisor's knowledge, so you don't go behind their back, assuming the supervisor is not involved. And that's the key. If your ethical conflict is with the supervisor, well, you should probably go to your next level. If following your employer's established policies for conflicts does not work, here's some other stuff you could do. Except where legally prescribed, maintain confidentiality. Clarify issues in a confidential discussion with an advisor. Consult an attorney. Don't sacrifice your ethics. So why do we have these standards? Well, as I said, way back in the early 2000s, some of you may not have been alive. Some of you may have or may not have been aware. We had a lot of fraud and unethical behavior occurring in corporate America. I mean, we always have that, but to gain confidence back in them, they really focused on creating ethical standards. So they're essential. When people are committing fraud and there's unethical behavior occurring, the market loses confidence in those companies. And if you don't believe me, go back to Enron and see what happens to their stock. The stock value decreases. So we don't want that happening because of unethical behavior. So to keep a smooth functioning economy, you need to have ethical standards. Without ethical standards, the economy and all of us who depend on it for jobs, goods, and services would suffer. And that's what happened. Abandoning ethical standards in business would lead to a lower quality of life with less desirable goods and services at higher prices. Excuse me, and I think back to that gentleman, and I can't recall his name right now. Maybe some of you know. A few years ago, he increased the price of a drug in his company like 2,000%. And it was a critical drug people were in need of. And people just said, well, why'd you do that? He ended up being arrested for some unethical behavior after that. But it was just, when there's unethical practices occurring in business, that people just lose confidence and there you go. Also, he just went and he just thought he could raise the price of a drug 2,000% or whatever percentage it was, and everybody would be okay with it. So society does respond to unethical behavior. From a strategic management perspective, a strategy is a game plan. Okay, so we in a company, we want to know where do we want to be and how do we get there? And it enables our company to attract customers and it distinguishes ourselves from the competitors. Think of Coke and Pepsi. They're the same exact thing. I know those of you out there who are Coke advocates would be like, no, they're not. But they're soda. How do they distinguish themselves? Customer value propositions. Okay, so customer intimacy strategy. So this is where we want to understand and respond to our individual customers. How do we deliver products and services faster and more conveniently? Product leadership strategy, offer high quality products. Okay, so all of these components are part of our managerial accounting because a lot of the components in that are management, right? A process used by a company to proactively identify and manage risk is risk management. Should I try to avoid the risk, accept the risk, or reduce the risk? So once a company identifies the risks it has, the inherent risk, and that's even part of internal control, they manage it. And the tactic is to reduce the risk by implementing specific controls. And that's a part of the process. So here's an enterprise risk management perspective. Here's your risk. Intellectual assets are stolen from computer files. Well, how do we combat that risk? Create firewalls that prohibit computer hackers. Products harming a customer, that may be a risk. Develop a formal and rigorous new product testing program. Losing market share due to the unforeseen actions of competitors. We'll develop an approach for legally gathering information about competitors' plans and practices. So you could read through those, but on a management side, we are trying to predict the risks associated with our company, our product. And we are creating plans to limit that risk. We have a corporate social responsibility. And this is very important in today's business world. It's a concept where organizations consider the needs of all stakeholders when making decisions. They're just not looking at themselves or their customers. They're looking at anybody who's involved with the company, customers, employees, suppliers, communities. What's the effect of this decision on the community? What's the effect on the stockholder? What's the effect on the environment and human rights? We've got to make the best decision for all the stakeholders. And here's some examples. And you could read through these. I don't need to read them to you, but just so you get a feel for what's involved in this. Process management perspective. So a business process is a series of steps that are followed in order to carry out some task. The classic example is the value chain. It's the process our product or service goes through from beginning to ultimately going to the customer. So we start with research and design, then product design. Managerial accounting is involved in all this process. Manufacturing it. How do we sell it? How do we market it? How are we going to get it out to our customers? And finally, how are we going to serve the customers once they have it? That's called the value chain. Now, lean production is what they call just in time, and Dell does this. Customer places an order, a production order is created. They generate the components required. Components are ordered from the supplier then, and they come very quickly from the suppliers. So companies in lean production don't keep a lot of inventory of components that they need to build the computer. They order them, and as soon as they come in, they build the computer, the goods are delivered. And the customer isn't waiting weeks for the computer. Just in time, the challenge there is finding suppliers who can deliver your goods, your materials needed to create a product for your customer as soon as possible. We'll be talking about that. Traditionally, the manufacturers ordered items that they needed, put them on a shelf in inventory, produced the goods in anticipation of a sale occurring, put it in inventory, wait for someone to come and buy it. What's the problem with this? You have a finished good sitting on a shelf doing nothing. You spend all this money to create a finished good, and now you got to wait for someone to buy it. Where in the lean production, you don't have anything sitting around on a shelf. The customer orders it, you bring in the materials and items to make the product for a customer who already bought it. So it's a different approach. Because lean thinking only allows production in response to customer orders, the number of units produced tends to equal the number of units sold. It also results in fewer defects, less wasted effort, and quicker customer response times than traditional production. So companies are moving towards this lean production. A leadership perspective. Remember, we have 6 different perspectives here. Organizational leaders unite the behavior of employees around 2 common themes: attaining strategic goals and making optimal decisions, the best decisions for the stakeholders. Factors that influence this are intrinsic motivation, extrinsic incentives, and cognitive bias. So there's psychology involved here. So take a read through the prologue. Like I said, it's just to get you familiar with what you're really undertaking this semester. You're not responsible for any of the problems or exercises, or you're not going to be tested on it. But like I said, just to get you familiar with the material before we begin.